SOFI Technologies is attempting to disrupt the banking industry. The stock has gained 70% this year, but it's still well below its all-time high. At the current price, the company has a market cap of $7 billion, but it's running at a net loss. Net income over the last 12 months is minus 400 million, and an EV to EBITDA multiple of 32 isn't particularly attractive. However, SOFI is growing at a rapid pace. This is a company that was founded barely 10 years ago, and it's now doing $2 billion in annual revenues, and interest income has more than tripled this year. Obviously, higher interest rates are a factor, but SOFI's deposit base now sits at $15 billion. That suggests SOFI is taking legitimate market share from the big banks, and with the student loan repayment moratorium at an end, there's a real opportunity for student loan refinancings to drive more growth going forward. Despite that growth, SOFI stock trades at only 1.3 times its book value. That's less than JP Morgan Chase and only slightly below Bank of America. Fellow fintech stock Upstart trades at 3.5 times its book value. In other words, SOFI stock isn't expensive, and if growth is real, the stock has a path to enormous upside. But nearly 15% of SOFI's float is sold short, because many traders are in fact skeptical of that growth. The problem with investing in disruptive financials is that it's not that difficult to grow deposits. It's much more difficult to do so without taking on risk. Crucially, after spending its entire history selling its loans to investors, SOFI began to keep loans on its own balance sheet. This decision increases net interest income because SOFI is getting interest payments itself, but it also increases downside risk because SOFI is keeping the risk of those loans on its own balance sheet. SOFI management says it's keeping its loans because it's more profitable to do so, but skeptics think SOFI is keeping the loans because it can't sell them without taking a loss in the current economic climate. Essentially, investors need to decide whether SOFI is truly a better lender than traditional banks. SOFI stands for social finance, and the company uses non-financial data to drive better loan decisions. If SOFI has found a method that gives it an edge over legacy banks and other competitors, then there's a path to huge upside in the stock. After all, the company is valued at only a fraction of most banks. But as skeptics point out, there have been hundreds of financial companies over the years who said they had built a better model for pricing risk. Most of those companies wound up at some point going broke. Without knowing exactly what is on SOFI's balance sheet, it's hard to know how safe this company is. That's why I give the stock a neutral rating, but these are my personal opinions, not financial advice, and I've got no position in SOFI stock. For more videos like this, check my website 3minutebreakdowns.com. Thank you for watching.